Happy Monday. We have futures hovering around record levels. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, the bull rally faces an earnings test this week. The likes of Goldman, United, and Netflix provide fresh clues on the health of corporate America.
No respite for Boeing, the plane maker announcing job cuts and steep charges as it lurches from one crisis to the next.
Plus, an exclusive interview with Keir Starmer. The Prime Minister speaks to Bloomberg about his plans to reignite investment in the United Kingdom. All that and more coming up. Let's take a look at where markets are trading 30 minutes until the bells ring. Of course, we have green on the screen, fresh off the 45th record close for the S&P 500, currently adding another 0.2%. Of course, big tech is your outperformer so far. The NASDAQ 100 currently up about 0.5%. You have NVIDIA, you have Tesla rallying this morning, helping to boost the benchmark. Meanwhile, let's take a look at the VIX, because even with all this good news, you do have an elevated VIX right now, Matt, currently trading with a 20 handle.
All right, so many investors tell us it's all about earnings. We kicked off earnings season officially with the banks on Friday. You can see here at the bottom of this chart earnings revisions, and for the last 4 weeks they have been down. That has not stopped the rally. We continue to make new highs. I think Katie just said 45 new highs so far this year. So we have a very low bar, it looks like, and falling even lower to hurdle to beat earnings expectations.
Well, let's take a look here under the hood. We do have a few things moving. Boeing moving lower after announcing job cuts and a $5 billion charge this quarter due to financial stress and strikes. You have Boeing down 1.5% pre-market. Looking at MicroStrategy as well, among the biggest gainers in the crypto world, cryptocurrencies and stocks have had a rally. MicroStrategy up more than 6%, and it's not the only one. We're also going to take a check here on SoFi. Just announced a $2 billion agreement to offer personal loans through funds from Fortress Investment Group. SoFi now up almost 9% pre-market. There will be more where that came from with the private markets, Matt.
All right, yeah, private markets for retail by SoFi. Very interesting stuff there. Look, we're kind of meandering, looking for a theme. We've got earnings coming out. We've got some housing data. We've got an ECB meeting. We're reaching, right? Really?
If we're talking about the ECB on Monday morning, listen, we don't have any earnings today. A little bit of breathing room. We have a lot of earnings this week, though. I mean, Sonali walked through some of them. And when you look at the scope of this earnings season, there's a great story on the terminal about the split between CEOs and analysts. Basically, analysts looking a bit downtrodden here, really revising earnings projections lower. And then you have CEOs saying, it's all good.
It's interesting, even though this week is fairly light, like 4.6 trillion worth of market cap reporting this week. The next 2 weeks are very, very heavy on earnings. And you have DataTrek coming out with some data this morning I found interesting. It's really the fourth quarter. The fourth quarter is supposed to have pretty excellent earnings as far as the S&P 500 goes. But this quarter is pretty muted, only about 3% earnings growth, guys.
Yeah, the bar a little bit lower there.
All right, but it seems nonetheless everybody is buying stocks, right? Let's talk about this with Cole Smead. He is the CEO of Smead Capital Management. And Cole, in your notes, I see a St. Louis Fed figure here that shows U.S. households hold more stocks relative to other financial assets than they have since the St. Louis Fed began keeping records in 1952. What does that stat say to you? Do we hold too much in terms of stocks?
Yeah, and thanks for having me this morning, Matt. It argues it's a historical precedence that you rarely see. The other two junctures you saw this high of ownership relative to the past history would have been 69, which was the highest to that point, or 1999, which was the highest to that point. And so looking back at those two prior instances, what you saw no matter what was negative real returns in the S&P 500. And in one case, there was nominal returns that were positive. In the other case, there were nominal returns that were negative, and that was obviously the 2000s. And so we look at it as a contrary indicator. When American households in this data own large amounts of stocks like they do, it shows you it is exuberance, it is confidence to a level in the stock market that you will rarely see. Now, am I saying that every American household owns stocks? No, that's not what I'm saying. I'm saying that it shows the extremity of wealth. The extremities would be Elon, would be Jeff Bezos, would be, Bill Gates and Steve Ballmer. Those are the extremities of wealth. And it just screams that when you run into those extremities, broad equities, as noted by the S&P 500, are a terrible 10-year investment.
I will say, though, Cole, I mean, I hear what you're saying on positioning, showing exuberance in this market, and certainly the best start to a year for the S&P 500 since 1997 would tend to agree with you. But even still, you think about some of the features of other bubbles that we've seen, if we want to call them that. You're not seeing, for example, the silly season in IPOs that maybe you've seen in bubbles past. I mean, how do you square the circle that we're missing some defining features of that exuberance?
Yeah, it's a great question. History never repeats itself, but it rhymes. What we saw in 2022 was a lot like 1969, where the bubble of IPOs, to your point, and SPACs and all the other, the VC money raising, you can just put it all together. The activity on Wall Street peaked in 22 like it did when the 60s ended. Now, that didn't stop us from going on to the Nifty 50 in 1972, which, just for the record, peaked on my birthday, December 11th of 72. And then we went to a 2-year nasty bear market and begat the decade of really the lost stock return decade of the 1970s. So I kind of look at this like 1972, the bluest of blue chip, creme de la creme American businesses being as overpriced as they ever get. And you can wake up 25 years later, like Jeremy Siegel did in his book Stocks the Long Run, and he argued you should have paid at the top because you almost beat the S&P 500. That's great for an academic. I live in the real world. Our investors live in the real world. If in 25 years we can say we almost beat the S&P 500, I will be out of a job. I will be calling Michael Bloomberg to ask if I can get in the media business. So that's the issue here is in the real world, those things don't apply. And I think we can wake up with the bluest of blue chips in 5 to 7 years being down 55%, like Coca-Cola did from 72 to 79. Was it a great business? Yes. Was it going to grow a lot? Yes. Did it have a great balance sheet? Yes. And it lost 55% of its market cap.
I hate really talking about stocks as a monolith here. We could talk about the S&P 500, its performance, or the Nifty 50, the Dow Jones, or the NASDAQ. Yeah. The fact of the matter is that these companies change over time. You're a stock picker. Want to cite something that's been going on in the market, the S&P equal weight versus the S&P 500. Just over 3 months, you've actually had twice as good performance in the equal weight index. You've seen a rotation coming on. You're somebody that has already been invested on a lot of those names that those rotation trades have been coming into, like financials. Where do you see this going?
Yeah, to your point, it's not to say that all stocks are unattractive. That's not the point in this. It's just really the dollar-weighted opportunity, or what most institutional investors can do, is a very poor strategy. To your point, I mean, think of financials right now. This idea of a recession, it's a fleeting idea. It's really hard to find a recession. I call it the great unicorn. We know it's out there. We just can't find it. And that's the inherent issue. So like in the financial space, it's like we're running this carry trade. The carry trade is 7% of our GDP is spent in deficit. Can you get a recession when you're doing that? I find that hard to believe. And based on the politics in this season, I can't see it ending. And therefore, you're in an elongated cycle of economic growth. Yes, it's not real in many cases because it's federally spent GDP growth. But that being said, it's a great way to make money as inflation is not at bay, in our opinion.
We don't see any inflation in the energy sector. I saw premium unleaded at $4 a gallon yesterday, which is a pretty decent price for my region here. What do you think about energy investments now? Obviously, we've seen a little bit of volatility, but for the most part, I think people are bearish on demand. OPEC, I believe, recently announced again that it thinks demand is going to be slower growing, only 2% for 2024. So is fuel demand fading, and what does that mean for your energy investments?
Well, they've come out and said slower growth. They didn't say, it isn't going to grow. And I just look at the world as we're at 40 million barrels a day of demand. We got to go to 50 at some point as the world grows, because ultimately oil and gas are a good proxy of economic growth. And so I think less about the demand side, though, Matt. I think a lot more about supply. I mean, use the United States. We're the largest grower of production looking back 20 years. We are the largest grower in the Permian. And if the Permian cannot grow at the rate it did, that means where are we going to get the extra 10 million barrels a day from as we look forward over economic growth? So I think that's the biggest thing we think about is the lack of supply. And if you look at the reinvestment, CapEx as a percentage of operating cash flow in the oil and gas space, it's just not there. If you go announce you're going to do more CapEx, you're going to find a falling stock price on an oil and gas business. To the point earlier about the equal weighted versus the dollar weighted, energy isn't owned in either in any meaningful way. It's a great way to get rich in a decade that stocks are going to do terribly.
Well, Cole, let's talk about that a little bit more. I mean, why do you think that's the case? You take a look at energy equities. They had a great run a couple years back, but since then, I mean, declining last year, this year up 11% or so, underperforming the overall index. I hear that you're saying that this is a market focused on supply, but given the might of American oil producers, wouldn't you expect a better performance and more enthusiasm?
Not at all, because that's being overshadowed by the fact that the majors have been the worst performing over the last 3 to 4 years. So that's where the dollar-weighted money is. Again, you're back to your issue of where's the money versus where can you make money. And so I think a lot about that. From a market cap perspective, I think this is true for the S&P 500 as well. But if you really look in like a $5 to $50 billion market cap, there's lots of opportunities in energy where you made a lot better money, just like that's been true in the S&P 500. But that's not where the money's at. So if I can go out and buy mid to high teens returns and pay something like low single-digit book value multiples, I can do really well because I'm ultimately going to get the return of the business. Versus if I got to go out and buy Microsoft that produces 30% return in equity, and I got to pay like 10 to 12 times book, I better be right about my exit multiple, or else I'm going to have a lot of trouble if return on equity declines for any reason, or multiples contract because the inflationary pressures aren't at bay.
Cole, give us some names here. I'm really curious about what you're watching. We were just talking about how we're entering the thick of earnings season, particularly next week. What has the most upside in your portfolio?
Yeah, I mean, I frankly think what we're going to see in buybacks and also consolidation in the energy business, this is like a Boone Pickens market. You can dig for oil cheaper on the New York Stock Exchange than you can in the field still. And I think what we see the majors should be doing is consolidating more. Ultimately, we're buying the companies that they're going to have to acquire. I mean, that's broadly speaking, outside of Conoco, which is our only major that we own. So we are in Ovintiv, we are in Apache, we own Devon. Our biggest holding in the space is actually Occidental Petroleum. I think the other thing you'll see is cross-border mergers. I mean, we're up in Canada in names like Meg and Synovus that we also own in our U.S. portfolio. And then we own a company called Strathcona. Billionaires have been made in this business rarely. And you can go out and buy businesses that billionaires are involved in, and you just don't find that in most companies. Strathcona has that with Adam Waterous. And so we think the space is going to probably end up with 5 to 7 players, whether you're in Canada or the United States. The flip side is go look at what the regional banks have been doing since last fall. 1 year ago, it's been a great place to compound money. And again, you're getting mid-teens returns, and you're paying something closer to book. That is so vastly different than paying 4.8 times book for the S&P that's producing almost similar returns.
Cole, we have to leave it there, but great conversation as always. Positioning for consolidation, that is Smead Capital Management CEO Cole Smead. Meanwhile, a check on futures to kick off this trading week. Looks like we have a green day on our hands, but it's very early. The S&P 500 up about 0.3%. Big tech is your leader so far, currently up about 0.5%. Can't say the same for the small caps, but the Russell 2000 in the green as well. Meanwhile, let's take a look under the hood. We'll do that with Abigail Doolittle.
Katie, let's start out with some stocks that are moving on corporate and deal news. Southwest Airlines up 1.2%. This is Elliott is seeking a special shareholder meeting in their proxy battle. In that battle, they've nominated 8 directors, and they're looking to replace 8 old directors. It's their first proxy battle since 2017, and this is the first special meeting that they have asked for in this particular proxy battle. B. Riley Financial up 18%. The beleaguered financial company has struck a deal with Oaktree on the Great American Partnership. They're basically going to do a reorganization into this other company. They'll receive $203 million cash plus a stake. Turning to some stocks that are doing a reversal from Friday's action, the shares of Tesla are up 1.4% last week, down on some disappointment, early near-term disappointment on the robo-taxi concept and the sense that there's light on detail at this time. Alibaba up down 1.3%, falling on a little disappointment around China stimulus hopes. And then finally, the crypto space, it is higher. Bitcoin up by a couple percent on the China stimulus that there is, plus the betting odds favoring Donald Trump, and he is thought to be pro-crypto. So on this, we have the likes of MicroStrategy, Merrill Holdings, and CleanSpark all up about 5% or more.
Abby, thank you so very much. Now, coming up, Boeing plans to cut its workforce by 10% as the manufacturing strike enters its second month. We're going to have more on what's next for the plane maker. Stick with us. This is Bloomberg.
Let's get now to high interest and look at what's making headlines around the world. And the Nobel Prize in Economics has gone to 3 economists studying Europe's colonial legacy. Simon Johnson, one of those winning economists, joined Bloomberg Radio earlier to talk about his research.
Technology has hurt people. We've had excessive automation in the past 40 years. We've not generated enough new, good jobs, so jobs where you actually get paid good money and you can live well. And we've got to do better on that. I think that that's really a fundamental driving importance, irrespective of the election outcome.
The 3 researchers were praised for their analysis of how economic prosperity can be achieved. B. Riley Financial will sell a majority stake in its Great American Holdings business to funds managed by Oaktree Capital Management. B. Riley will receive about $203 million in cash and get 47% of the common units of a reorganized Great American. Bloomberg reported the talks earlier this year. And SpaceX stunned the world over the weekend when Elon Musk's aerospace company managed to catch a portion of its rocket using giant mechanical chopsticks. It's a critical milestone in its quest to create a rocket capable of flying to the moon and then to Mars. SpaceX also won key approvals for its 2 rocket systems in recent days. Sonali?
And we're going to look again at Boeing pre-market because the company will eliminate upwards of 17,000 roles as it grapples with regulators, manufacturing strikes, and financial strain. Let's discuss this all with Bloomberg Global Aviation editor Benedict Kamel. Let's think through for a minute just the scope of challenges being faced. The most recent kind of plan to cut jobs here, how much does this really give Boeing some room financially as it begins to really weather this storm?
Yeah, Boeing came out with this late on Friday, and there are a lot of parts in this announcement that we don't understand yet and don't know. So 10%, as you said, that's about 17,000 jobs. But cutting jobs also costs money. You know, they'll have to pay severance. That part is unclear. It's also unclear which part of the business they will have to cut jobs. Is this more in the commercial part? Is this in the space and defense part of the business? Those are all questions that are unanswered at this point, and the company will probably work through some of these during this week. They're due to announce earnings next week on the 23rd. They already gave us a bit of a glimpse into their financial state last week on Friday. They said that their earnings are down. They actually had another big loss. And crucially, they had huge charges, all in all about $5 billion in charges around the commercial and the space business. So as you say, this is a company that is really in a very tough spot. The 10,000 or the 10% job cuts are happening at a time when the strike is going on. And obviously, this is not going to go down well with the workers who are sort of raring for a fight.
Yes, well, that's what I want to talk about, because you think about how much cash Boeing has. It had $10.5 billion in the third quarter, better than expected, but still low levels for a company that's trying to avoid going to junk rating. But talk to us about how this interacts with the strike. It seems like, of course, Boeing in dire straits here, and the union has relatively lofty demands relative to this company's fundamentals.
Yeah, you're right. I mean, the 10 billion, they're just above that crucial 10 billion threshold. That's the money that Boeing says they need to operate on a day-to-day basis. And dipping below that would obviously require them to seek fresh funding. And that's something that we have reported is in the works, that they are exploring some kind of a capital raise. The floor of that is about 10 billion. It could be substantially higher than that. The big unknown in all of this is, what is the strike going to cost them? How much longer is this going to drone on for? We are now in the 5th week. There's really no sign of an agreement at this point. There are no talks taking place. So really, we're in uncharted territory in terms of what this might cost, how long it'll take, and frankly, some observers are asking, why is Boeing not coming back to the table? The cost of paying the workers more is manageable, and it's probably a lower cost than the damage that's done by this extensive strike. So really, it's a balancing act for Boeing. How much are they willing to give workers? They're not that far apart. About 30% is what's on the table from Boeing, and about 40% is what workers would like. So it's not that big of a delta, but for the time being, no talks taking place.
Benny, I'm wondering about the knock-on effects. You and Sid and our team globally cover, obviously, the entire industry here, and Boeing isn't able to make deliveries, right? They said on Friday 777X deliveries are going to be delayed until, I think, 2026. How is this affecting their clients, their customers?
Well, we already heard from their key customer, which is Emirates today. They are by far the biggest buyer of that aircraft. This is the sort of updated derivative of the 777, the 777X. That plane was already delayed. Originally, that plane was supposed to come out in 2020. That gives you a sense of just how late it is. And Emirates was saying, very unhappy about this. We're going to have some robust conversations with Boeing, I imagine, about compensation. But across the industry, everyone's very unhappy about these delays.
Yeah, big time. And Ortberg saying on Friday that they need to be clear-eyed about the future. It's going to be a fascinating story to follow. That is Bloomberg's Benedict Kamal with the latest on Boeing. Now, coming up, casino and gambling stocks under pressure this morning. Details next in our Social Climbers. This is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller, and you're about to see something historic. I believe that we will open at the highest level we have ever seen the S&P 500. If we continue into the green after those opening bells, this would be the 46th record day this year. Let's take a look at the New York Stock Exchange. You have women in finance ringing the opening bells, but they have a dude doing it. That doesn't make a lot of sense. I thought Megan Griffiths was going to be the film producer there ringing the opening bell. Down at the NASDAQ, you have Micron ringing the opening bell, and we'll be paying obviously close attention to see how many chips they can make for the AI craze. But most importantly, Katie, have we done it? Have we achieved a 46th record high?
For at least 29 seconds, it looks like, yes, we have been at a record high on the S&P 500, currently higher to the tune of 0.3%. And Matt's right. If that holds through 4 p.m., that would be the 46th record high. This has been the best start to a year since 1997. And you're seeing that enthusiasm in the NASDAQ 100 as well. Of course, big tech rallying today, lifting the benchmark by about 0.5%. The small caps not exactly seeing the same exuberance as Cole Smead would say. The Russell 2000, I'm going to go ahead and call that flat on the day. But let's take a look under the hood, because Boeing shares moving on its announced 10% in job cuts, which equals about 17,000 positions. Of course, the plane maker also said it will incur a $5 billion charge that is due to financial strain, manufacturing strikes. You add it all together, shares only down about 1.5%. But Sonali, this stock is down by more than 40% so far this year.
You know, Katie, you said stocks were flying, and so is crypto. We're keeping an eye on MicroStrategy, this stock, as it's rising about 4% alongside Bitcoin. Traders see Beijing's latest stimulus efforts as an opportunity for blockchain investment. Matt, you see more crypto stocks flying along with it.
All right, and companies worth more than $4.5 trillion, Sonali was downplaying that, but it's still a huge number, are going to report earnings this week. Third quarter profits are forecast to expand 4%? That seems a little bit high. It is the slowest rate in a year, but I saw 3.2%.
That's actually right. Analysts, at least according to data gathered by Bloomberg Intelligence, expect S&P 500 earnings to come in at a 4.2% increase year over year, but that's down from a 7% forecast that they gave in mid-July.
It's better than the chart we just had up.
It is better than the chart.
Because that chart said, I think, 3% and change.
Well, clearly you can quibble over the numbers there, but in any case, of course, we have seen those revisions getting downgraded, and it's not really slowing down the S&P 500 at all, of course, with all those record highs.
30 trillion worth of companies, more than that, almost 32 trillion over the next 2 weeks. So if you think this week will feel like we get a glimpse into the economy, the next 2 weeks will give us a lot of information on what to know ahead.
At least we'll have something new to talk about, you know? Of course, the Fed seems to be in risk management mode. We've just been hovering around these record highs, so at least we'll have some catalysts coming up.
China delivered us nothing.
Exactly. Of course. Let's go now to London, where Stephanie Flanders is standing by with a very special guest, an exclusive interview happening right now.
Thank you so much, and we are delighted to have the Prime Minister, Sir Keir Starmer, with us at the International Investment Summit here in London. Prime Minister, in your speech earlier today to the summit, you vowed to do everything in your power to galvanise growth in the UK. But if you look at the sharp decline in business and consumer confidence since you were elected, since you started talking about all the tough times ahead, the tax rises ahead, you'd be forgiven for thinking you'd done the opposite to growth. So I guess I'm wondering, are you feeling now you might have overdone all of that a bit?
Well, today was very much a statement of intent to say very clearly that economic growth is the #1 mission of this government. And that means that we're open for business as a country. We want to drive that investment into our economy. And we want to see that in jobs, secure jobs in different parts and all around the United Kingdom. So that's very much the message from today. There's been a drumbeat of inward investment over recent weeks, which I think demonstrates that although, yes, of course, we've had to signal that there are tough decisions to make because of the damage that's been done to our economy, and we've just got to be straight with people about that. We do have amazing assets in this country in terms of our skills, our people, our universities, our cutting edge when it comes to technologies like AI, for example. And that's why making that really clear statement of intent today was very important. And I think quite a lot of the inward investment decisions we've seen, running into tens of billions, are vindication, if you like, of the approach that we're taking in partnership with the investors and the businesses, many of whom are here today.
I mean, one of the things that you've been clear about was that tax, and the Chancellor's been clear about, is that difficult decisions will be needed, tax increases will be needed to pay for that investment in public services that people are expecting. And given all the taxes that you've ruled out, there's a lot of concern here in the business community about increases in capital gains tax and in wealth tax. Now, I know you're not going to want to go into the details of the budget, but are you reassuring the investors here that they have nothing to worry about on that score?
Well, I'm not going to get into the details of the budget. You wouldn't expect me to. But neither am I going to shy away from the fact that we've got difficult decisions to make. The last government left a £22 billion black hole, and we're not going to walk past that. We're going to have to deal with it. So that'll be tough. But what I've been able to be very clear with investors and businesses is that because growth is the #1 mission, then decisions, whether it's on the budget or anything else, will be determined by whether they help growth or not. So that's the lens through which we're seeing this. But I have to say, the discussion here, we've had intense discussions all day long, last night as well, with a number of people in the room that we've got to know over the last 2 years. So this isn't the first time we're meeting. All of the discussion today has not actually been about tax. It's been about planning. It's been about the regulatory environment. It's been about getting infrastructure moving much more quickly and the sort of apparatus of government working to that common end. That's the real discussion that's going on here. That's the real focus. And actually, contrary to perhaps what people might think, tax is not the first thing that businesses and investors are raising with me. First thing they're raising with me is it really your #1 mission? Is it going to be stable and strategic and for the long term, to which the answer is yes? And are you prepared to do the tough things on execution and the deliverables, which is about the length of time it takes from investment decision to actually seeing a project materialise? That's where I think we've been able to do a lot of reassurance that, yes, we understand that, and we're determined to do the follow-through on growth that is desperately needed for investors, for our country, and for the jobs of the future.
But forgive me, Prime Minister, but I think a lot of people, they may not be talking about it to you, but a lot of people are worried in this sort of vacuum that we've had, quite a long wait for the budget. There's quite a lot of what might be just crazy speculation around where capital gains tax might go, for example. So something like a 39% rate. Can you reassure people that whatever the change is, it won't be anything that significant?
Well, quite a lot of speculation is getting pretty wide of the mark. But
so you say that 39 is wide of the mark?
Yeah, it's getting to the area which is wide of the mark. But I'm not going to fuel the speculation because we can go on like this for a very long time until budget day. Everybody knows that until budget day, none of it is going to be revealed. It was important that when we came into office, into government, we looked at the books, we assessed the state of the economy. We needed to understand the damage that's been done, and that £22 billion black hole is a real problem that we've got to deal with, and make sure that we go through all the processes necessary for a properly thought through budget. So that's why we put the timing as it is. It's the right timing. But equally, it's been really fantastic to have this investment summit just a few weeks before the budget, where the mood music here is very upbeat. People are talking about a real opportunity now to invest in the UK, comparing it as a sort of relative advantage across the world. We want to seize that opportunity and take it forward with many of the investors that are here.
You're looking at the books, but obviously people are also just sort of checking when they think about, I know you're not going to reveal what's in the budget, but when they're thinking about what you've committed to and what you've not committed to. For example, the pledge not to increase national insurance contributions. Most people I talk to think that if you increase the employer side of that, the employer contribution, that would be breaking that pledge. Can we, without getting into the budget, can I just check that is your understanding, that that would be breaking that pledge?
Well, you're saying without getting into the budget, then tempting me
well, it's just you're
further
explaining
and further down.
Your pledge.
We made very clear
meant.
commitments in our manifesto, and we intend to deliver on those commitments. Beyond that, I'm afraid you'll have to wait for the budget for the details. For very obvious reasons, we're still weeks away from the final assessment in the budget.
I guess that what feel, you said it's the right timing for this summit. It does feel a bit odd that for those people in the room, people who are doing deals today, you can't promise them that the basic tax environment for entrepreneurship, for business, for wealth in a couple of weeks' time won't be completely different.
Well, they're very interested that corporation tax is capped. They know exactly where that is in the long term. They're very interested in the fact that we're able to say that because we've got a good, strong majority in government, we're able to make decisions based on years, not months, with a clear strategy. They're very, very interested when I talk to them about being a mission-driven government, a government with a real sense of purpose measured over years, with one central purpose, which is wealth creation translated into jobs in different parts of the United Kingdom. That's the sort of stability that they're looking for, and that's the conversations we're having. They're very pleased to hear that from a government, are very pleased about the clarity. There's no end of people here today who said the clarity of the message is really welcome. It's now the follow-through, which is actually the execution of it. What are you prepared to do when it comes to planning? What are you prepared to do when it comes to regulation? It's not just the number of regulations, it's the inconsistency of regulation that we need to deal with. And when I'm able to say with real confidence and certainty and clarity, yes, we're going to deal with that, that leads the decisions, in my view, to make the sort of investment that we've seen in recent weeks, which is very welcome. These are not just big numbers, although they are big numbers. They translate into jobs around the United Kingdom, good, well-paid, secure jobs. And that's the change we promised at the election and the change that I'm determined to deliver on.
So you talked about mission-led government, and an ethics-led government's obviously been a feature. You had a sort of unfortunate slip on the way to this summit involving DP World, which I'm not going to go into, you'll be glad to know. But there is another company, Sheen, which was considered to be such a rogue operator in the US that it hasn't been able to list on the US stock market. It was too controversial, its working practices. But it seems that that your government is continuing their sort of open arms policy for wanting Sheen to list here. Is that right?
Well, I think we've got to get the balance right. And clearly we've got to have standards, high standards. We do have high standards. Not least, for example, in rights at work. And I addressed that in my speech here today to say, look, better rights and protection for people in their workplace are good for growth. So we're clear where we stand on standards. But we're future looking, we're pragmatic. And subject to those standards, then yes, we do want investment into the United Kingdom because we desperately need growth in this country. We haven't had meaningful growth in the economy in the United Kingdom for 14 long years. We're determined to turn that around.
But just to be clear on that, so the government would need to be sure that Sheen's not using forced labour in Xinjiang before it could list in the UK?
I'm not going to get into individual businesses. What I will say, and be very clear about it, standards and high standards do matter to us. So of course we'll be looking at any issue that goes to high standards, with a particular feature on the rights of the workforce. We've been really clear that we see that as two sides of the same coin when it comes to growth. Good employment rights and protections, and a lot of drag on growth. They're fundamental for growth, and I think pretty well all good businesses understand that, which is why in many cases they've already put in place some of the rights and protections that we're bringing forward in legislation.
On China, and you had an interesting conversation with Eric Schmidt this morning that touched on China. I'm interested, right now we have the Chinese army holding drills around democratically governed Taiwan, which they admit are a rehearsal or a practice for a full naval blockade of this place that produces most of the high-quality advanced chips in the world. I'm just wondering, we have the Foreign Secretary on his way to Beijing later in the week. Do you worry about the timing? Do you worry about the signal that sends on a week that the army is literally practicing potentially an invasion or a blockade of Taiwan?
Well, the approach I'd take is this, that national security has to come first. So that's the number one priority. And therefore, of course, we challenge where it's necessary to do so. But we're also pragmatic, and we want our country to move forward and to succeed. So challenge where it's necessary. But there are areas
but not
where...
Not necessary when they're drilling
we
this
have
kind of practice.
Challenged. We do challenge. I myself spoke to the President. We do challenge where it's necessary to do so. But, we are pragmatic as well, and we need to make sure that we get that balance right when it comes to our relation with China.
Just to follow up on that, when you say pragmatic, it feels like you're going to be more pragmatic than the previous government. They ceased into that sort of major economic cooperation, the dialogues, other things, when China imposed the national security law on Hong Kong. Are we sort of officially saying we're over that now?
Well, I think the problem with the last government is they veered from one side of the road to the other side of the road and then back again, and that just led to a pretty chaotic approach. I think everybody understands the national security first approach that we must take and will take. Everybody understands that we do challenge where it's necessary to do so. But equally, when it comes to, for example, climate change, we're going to have to work with countries like China because it's the only way that we can all go forward.
Prime Minister, we've run out of time, but thank you very much for joining us. Good luck with the rest of the summit.
Thanks very much.
Back to you in New York.
All right, and that was Bloomberg's head of economics and government, Stephanie Flanders, speaking exclusively with UK Prime Minister Keir Starmer, of course, speaking at the Global Investment Summit in the UK. Very interesting conversation. But let's get back to the U.S. market right now. Of course, we are 15 minutes into this Monday trading day. You do have green on the screen. Of course, that rally continuing to build on your big benchmarks. The S&P 500 currently up 0.5%. This would be a 46th record close if that holds. The NASDAQ 100 up 0.8%. Small caps not feeling the love today, of course, currently down about 0.2%. We're ignoring the bond market because it's closed, but that stock market, it's open and it's higher. This is Bloomberg.
Happy Columbus Day.
Welcome back to Bloomberg Open Interest. Let's take a look at this stock market as gains continue to build at the S&P 500 level, currently up about 0.6%. Of course, big tech rallying in force today, and that's part of the reason why you see the NASDAQ as your outperformer, currently higher by about 0.9%. Certainly helps that you have NVIDIA a little bit higher this morning. The Russell 2000, your small caps really fighting to stay green, failing so far. Your small caps currently, I'm going to call that unchanged. As we were just discussing before the break, of course, the bond market is closed today. Maybe that's a little bit of a relief given how volatile things have been over there.
I'm going to look ahead to earnings now, Katie, because we have $4.6 trillion worth of stocks reporting just this week, even more in the next 2 weeks. Last week was a strong start for earnings season, with the banks helping lift that S&P 500 to all-time highs. We're going to bring in Jess Menton from Bloomberg News right now. You know, Jess, it's interesting. This morning, over from Nick Colas at DataTrack, he makes this point about earnings that before 2020, net margins for the S&P 500 struggled to get to 10%. But now we're looking at 12% margins despite higher rates, lower consumer confidence, elevated recession fears. So valuations are justified. But how much more do margins have to really deliver here to keep at these levels?
And it's a great point, because it really comes down to those consumer packaged good type companies and staples, as well as those kind of retailers when it comes to the discretionary type space, because coming out of COVID, that's the ones that were hit the margins the most. And then also healthcare companies, for instance, a couple quarters ago, those expectations from Gina Martin-Adams over at Bloomberg Intelligence that most of that, right, exactly, so popular here at Bloomberg, that most of the pain was passed because there was a lot of accounting issues with healthcare companies like Bristol Myers in recent quarters. So when you're looking at healthcare, consumer staples, as well as some of those retailers in the discretionary space, that's where you're supposed to see it improve the most. But those expectations, of course, when you're looking overall for the third quarter, if you look at that Bloomberg Intelligence data that they were crunching here, expectations for growth for the year-over-year period is supposed to be just over 4%. So that would actually be the weakest if you're looking at growth in about 4 quarters. But we've seen this strategy before where you've seen analysts lower the bar on those expectations, because for some context, if you go back to June and July, the expectations for the third quarter growth would have been above 8%. So if you lower the bar, more likely you're going to see companies beat those expectations. And Bank of America already is starting to see that.
I was going to say, also executives too. I mean, we talked about JP Morgan all last week lowering the bar for themselves. Then you think about Goldman tomorrow. You had David Solomon say last month that trading isn't going to be as impressive.
Right, but it seems the consumer continues to surprise to the upside. I went to a stand-up paddleboard witch festival this weekend.
Oh, okay.
In Sleepy Hollow.
Should I even ask what that is?
Wait, where was this?
In Sleepy Hollow.
Okay.
So basically a bunch of witches out in the Hudson on stand-up paddleboards, and they had food trucks and face painting and kids games, but the lines at every sort of event were so long, hours-long waits. You know, I've noticed this at every festival that I've gone to over the 4th of July. You know, any weekend in Bronxville, it's absolutely packed with tourists looking to spend money.
People are buying popcorn, but are they going to buy a Ford?
Well, I've just noticed that consumer discretionary stocks continue to underperform, right? And I'm not sure if they'll buy a Ford if it's an EV and it's expensive. Apparently not, but they're definitely spending money.
They're buying wands.
Exactly. Well, it depends on where you're looking at within the discretionary space, because you were talking about EV makers and car makers. Obviously, Tesla's in the discretionary sector of the S&P 500, but so is Amazon and other retailers like that. Or even if you're thinking about Home Depot and those types of home improvement type companies. So those, if you're an Amazon or a Home Depot or a Lowe's, some of them have seen obviously better margin growth as well, but then other corners of discretionary too haven't as quite as much. So that's kind of the conundrum there. Where are you looking at when it comes to discretionary?
I do like using the witch festival as sort of the bellwether for the consumer overall.
It is spooky season.
Let's talk about the rest of the market though, because of course big tech is going to be in focus next week and really this entire earnings season. I'm looking at your notes. You post that outside of the Mag 7, and if you take a look at profits, expected to decline 1.8% in the third quarter. That's anemic, it feels like. Is that really going to be rocket fuel to fuel this broadening?
And that's what we've talked so much over the past year. And we saw a lot of that broadening, especially when earnings growth, as well as what translated to those stock prices in the other 493 in the S&P 500. But when you're looking at the third quarter, some of the growth, because in the second quarter, the other part of the S&P 500, actually the earnings growth was around 9%. So when you have a little under 2%, you're kind of wondering, well, can this continue? But if you look at further out, so toward the end of this year, also the beginning of next year, the rest of the S&P 500's earnings growth is supposed to be in the double digits, so it's supposed to narrow for big tech, but be more in line. But again, I don't want to say that, you know, growth when it comes to AI is slowing down too dramatically here, because the year-over-year base effects, say with NVIDIA, with that blockbuster revenue forecast a little over a year ago, when you were coming down from such a low base in 2022, that was obviously during the bear market, and there was an earnings contraction at that time, the base over base effects were so much higher. So now it's just harder to beat that. So that's why you're seeing that narrowing growth when it comes to big tech.
You know, it's interesting. There's so much optimism. We have to talk about the risk. Where are the sectors that you expect the most pain?
it's actually energy. So when I was talking about how we've seen those expectations come down so much for the third quarter in recent months, it's energy that was cut the most. And a lot of that had to do with, probably not surprisingly, when it came to the performance of crude prices in the third quarter being lower. So because of that, that's where you're seeing that. And then beyond even just energy, it'd be more kind of commodities focused type industries like materials as well. So that's where you're seeing more of the pain. So when we're talking about the other corners of the S&P 500, it's not broad based where you're seeing the earnings estimates coming down. It's more energy and then followed by materials too.
But bottom line, so energy is crazy that they can't even get more than $80 a barrel for Brent,
right?
Even amidst an escalating war in the Middle East. And I think today's OPEC report highlights that, growth is really slowing. I mean, 2% is not even as good as Disney World in terms of visitor growth. But in terms of the other 493, I see that we are expecting less than 2% profit growth for them, but it would be the second consecutive quarter of profits. They had almost 10% profit growth in Q2, and you're saying going forward, double digits.
Right, so the beginning of next year, so the first quarter in 2025, that's where it's expected to be above 10% growth, and then that would be kind of coming in more in line with the rest if you're thinking about the Mag 7 kind of cohort and where their earnings growth would be.
But they're slowing, right?
They are.
Their growth is slowing.
So the third quarter would be around 18% growth for a year-over-year period, and for some context, in 2023, their average was around 35% growth for those 7 type of companies.
All right, a lot of numbers, but you can read all that stuff if you go on the terminal or Bloomberg.com, search for Jess Menton. You can also type BIGO on the Bloomberg terminal for all of Bloomberg intelligence research. Coming up in the next hour, Pat Gallagher joins us. He's chairman and CEO of maybe the biggest insurance brokerage you have never heard of. Gallagher coming on next to talk about the aftermath of the hurricanes. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, the bull rally faces an earnings test with CEOs and analysts at odds about corporate America's profit outlook this season.
The bank earnings season is off to a positive start after JP Morgan and Wells Fargo. Next up, we get results from Goldman Sachs, Bank America, and Citigroup.
And as recovery efforts continue in response to hurricanes Milton and Helene, we'll survey the aftermath with the CEO of the global insurance brokerage, Gallagher. 30 minutes into the trading session, though, let's take a look at markets right now because we do have a rally underway, currently higher by about 0.6% on the S&P 500. That's good for another all-time high. We'll see if that one holds through the close. Meanwhile, big tech is really the leader of this market. The Nasdaq 100 up by more than 1% as volatility drains a little bit from the equity market. Of course, we're at elevated levels on the VIX above 20, but still coming out a little bit today, Matt.
All right, hedge funds are reversing their bearish stance last week and bought U.S. single stocks by the most since December of 2021. Bloomberg's Natalia Knijevich has more on the positioning. Natalia?
Hi, Matt. Yes, finally, we do see this big move from hedge funds. How long will it last? We don't know, but at least last week they bought 7 of the 11 of the S&P 500 sectors. We see that healthcare was definitely the outperformer here. They bought the sector at the fastest pace in more than a year. That was followed by financials and industrials. We still see that they're buying information technology sector, but it's really important to look at a subsector level. They buy software stocks, but they keep selling semiconductors. And then on the flip side, we see that this high-yield dividend stocks such as utilities and real estate were net sold. Now let's look at the options market. One group of stocks we should definitely keep an eye on is small caps. We see that basically this chart shows ratio between bullish bets, call options, and bearish bets. And we see that this is now at the highest level. Those bullish bets are at the highest level since the end of September. Maybe traders are positioning after that Federal Reserve's rate cut But it can also be related to the U.S. presidential election, because Citigroup came with a note yesterday, and they analyzed the S&P 500, NASDAQ 100, and the Russell 2000, and they said right after the election, the biggest move, Katie, will be in small caps.
All right, Natalia Kunijevic of Bloomberg News, thank you so much for that setup. And let's keep the conversation going now with Larry Adam. He is CIO over at Raymond James. His 12-month target for the S&P 500 is 5850. And of course, Larry, we have to start right there because I'm taking a look at the S&P 500. We're 3 points higher right now. I mean, tell us about your target, and are you going to raise it?
Not as of right now. We'll see what happens when we go through earnings season to see if we have to take our earnings higher. But you have to keep in mind, put some perspective. We've rallied now for 5 consecutive weeks. We're up 8% plus from just in early September. Keep in mind, we just celebrated the 2-year anniversary of the bull market, and historically, when you get into the 3rd year, that tends to be more muted performance. On average, it's only up about 2 to 3%. And then one other thing with the previous speaker, some of the optimism that's out there. If you look at a lot of the sentiment indicators, whether you look at the AAII or even in the Consumer Sentiment Index, you're now talking about people being bullish at levels that are consistent with the market being flattish to slightly down over the next 12-month period.
In terms of the valuations, I mean, we're at a higher level for S&P 500 valuations, taking out the pandemic, than we have been at any time since 1999. And we were just talking with Cole Smead, who was telling us that household ownerships of financials is also the highest that it's been really on record. Are we stocking up too much on equities here?
So no, first of all, I think the valuations are fairly valued right here. And one of the things that I think that's important to take into account is you have to look at the exposure of the index. And one of the studies that we've done is, for example, we take the current PE of each and every sector in the S&P 500, but then we go back to their weightings that were back in 2006, which is basically just going back before the great financial crisis. If I do that adjustment, the PE isn't 22, it's about 17.5. And I think that that's important to understand, that we have a lot more exposure to those higher PE names and sectors, and that's one of the reasons why this valuations are a little bit more expensive.
Larry, if I think about what's going to push this market ahead even further, we look at the earnings season ahead of us. Very soon, once we see the big tech companies starting to report, we're going to have that conversation again around CapEx spending. With the AI exuberance you're seeing, you could ask the same for many other companies as well. I understand you're looking at dividends, expecting to increase as well. If you're investing in the market tomorrow, how do you prefer to see use of funds moving forward? Do you want it back to shareholders, or do you want it reinvested in the company through the form of AI investment and M&A?
Well, I think it's all of the above, and I think it depends on which sector you're talking about, right? Because, for example, when you look at the technology space, they're doing all of the above. They're either initiating or increasing their dividends. They're buying back their stock, but they're also investing to make sure that they maintain their competitive advantage in their respective areas. And I think that that's a pretty important thing, because that's an area that continues to drive its earnings. In fact, this quarter, and you had it previous with your other speaker, is we're looking for the mega cap tech stocks to pretty much have year-over-year growth of almost 20%. That's significantly higher than the market. That'll be the 7th consecutive quarter that that's happened. But more important, that's likely to continue to happen throughout all of 2025. So that's a sector that's doing a little bit of both, and I think that it's helping its performance overall.
All right, Larry, let's talk about the little guys. Let's talk about the small caps. We often dunk on the Russell 2000. Of course, that's the small cap index that everyone references. But, I mean, the narrative is out there is that it's a pretty junky index. Then you take a look at the S&P 600 small cap index, for example, much closer to its all-time highs than the Russell 2000. When you're evaluating the smaller company space, how picky, how selective do you have to be in this moment?
I think you have to be very selective. To your point, if you look at the Russell 2000, 44% of the companies don't even have earnings in that particular index, right? So I think that that gives a lot of fertile ground for outperformance in that space. So when we recommend different areas or asset classes, that's one where I think active money management is critical. But I do think small cap will do much better going forward. I think this will be a good quarter for them. It'll be the first time in 2 years where you actually see positive earnings growth. And then when we get the next quarter, it could rival, if not exceed, the earnings growth of large cap. And I think that that'll start to bring more money into that asset class, and it'll help drive it higher.
The large caps, I mean, at least the S&P 500 is expected to have buybacks remaining at elevated levels, right? Why are companies using cash to buy back shares at these valuations when they could, some would say should, be spending more money on AI, for example?
Well, I think they are doing both. I mean, first of all, the cash flow that's been coming out has been incredible, right? And they want to invest in buying back their stock. When it comes to AI, the trend that I'm seeing is that the leaders of each of the respective sectors are really starting to see the business case and use cases coming forward. And as you see more and more of the productivity gains that these companies are having, you're going to see more and more of the smaller companies start to invest more. So I think that we are still in the early stages of AI, and you're going to continue to see that spend ratchet up. In fact, that's one of the reasons why we don't think we go into a recession. I think corporate spending in the AI space specifically will help drive this economy next year.
Larry, thank you so much for joining us today. Of course, a busy week of earnings ahead and a lot of questions around those favorite trades. That's Larry Adams at Raymond James. It's interesting, guys, as he talks about the AI trade, you have NVIDIA about to reach another record high. And fascinating enough, you have the Philadelphia Semiconductor Index up another 1.9% today. Most stocks in the green in that index, and NVIDIA is not even the biggest gainer in it. So a lot of love around the sector today.
Yeah, it's the reason why you've seen the NASDAQ 100 rise most of this morning. Of course, when it comes to the fundamentals, we did hear from Jensen Huang last week. We know that Blackwell was delayed due to those engineering snags, but he said that demand is insane. It's in full production. Unsurprisingly, he's bullish on Blackwell, and apparently investors agree with him.
Yeah, you know what I found fascinating this morning? We got the Nobel Prize for Economics. 3 men won it for a paper on how nation states achieve prosperity through institution building. But he was also on, one of these guys, I should say, an MIT professor, Darren Acemoglu, was on Bloomberg Tech last week, and he was saying at most 5% of the workforce is going to have their jobs done or helped by AI, and that people are basically wasting a lot of money on this because it's not going to be an economic revolution.
It's pretty amazing. I mean, 5%, that's still a lot of jobs. But if that includes, like you said, of course, jobs that will be aided by AI, 5% is shockingly low.
And of course, we were talking to Nouriel Roubini last week as well, who had a lot more of a pessimistic view. I guess you would expect Dr. Doom would in that regard. Anyways, coming up, big bank earnings just getting started. Goldman, Bank of America, and Citi on deck. We're going to discuss it all with Erika Najarian from UBS next. This is Bloomberg.
Let's get out of high interest and look at what's making headlines around the world. SpaceX stunned the world over the weekend when Elon Musk's aerospace company managed to catch a portion of its rocket using giant mechanical chopsticks. It's a critical milestone in its quest to create a rocket capable of flying to the moon and then to Mars sustainably or somewhat sustainably. SpaceX also won key approvals for its 2 rocket systems in recent days. How awesome was that? Demand for EVs is showing signs of recovery, according to Stellantis and Renault. That's thanks in part to lower prices for the plug-in models. However, Stellantis CEO Carlos Tavares struck a cautious tone at the Paris Motor Show, warning that delays to the EV transition could lead to higher costs. And it may be an unpredictable election season, but one thing is for sure, Washington's hotels will be cashing in on Inauguration Day. A majority of the luxury hotels in Washington, D.C. appear to be fully sold out in the week leading up to January 20th. According to a Bloomberg analysis, only a handful have remaining availability, with some rooms prices up over 1,000%. Sonali?
And Matt, we are still in the thick of big bank earnings season, and tomorrow we're going to get results from Goldman, Bank of America, and Citigroup. Expectations are high after better than expected results from JP Morgan and Wells Fargo last week. Joining us now is Erika Najarian, UBS equity research analyst for large cap banks and consumer finance. And let's say you had an interesting reaction from Jamie Dimon last week when you asked and pushed about that NII number. They guided lower towards $87 billion, but we have Bank of America tomorrow. tomorrow. How do you expect Bank of America and Citigroup in particular to fare under this new interest rate regime?
So I think Citi is the easiest answer. I think their near-term net interest income, or NII, will be fine. But I think for 25, they're not really going to give us much insight. You know, keep in mind that they're neutral to U.S. rates, but they could be more sensitive to rates going down around the world. Now, for Bank of America, I think we'll get clarity in terms of the trajectory of NII. I think we'll get good news from them in terms of saying, hey, we've already hit our trough, and we could have an upward sloping net interest income curve into 2025.
Let's also talk about Goldman. Of course, it was interesting to get JP Morgan last week, surprising on NII, even though Daniel Pinto had said that maybe we were a little ahead of ourselves. When it comes to Goldman, you had David Solomon explicitly say that he's looking for a 10% drop for the quarter when it comes to trading, or that they were on track there. Do you think that this could be another case of them setting the bar a little bit lower?
So broadly speaking, both trading and banking dynamics were a little bit better than expected at JP Morgan. And so that's our, they're the best in class, right? And they're our only hint. Citi usually reports on Friday. But I suspect that given the volatility that we've seen, especially in the equity markets, I think broadly speaking, you'll see potential upside surprise in trading this week.
Interesting. So specifically for Goldman included there?
So we don't officially cover Goldman, but for B of A, we expect some outperformance in trading.
I just want to clarify for any viewers wondering what NII is, that it's net interest income. So essentially it's the difference between the money a bank charges on loans and is paid on or pays out on deposits. What can you tell? What can you tell about the consumer health from the reports that we've seen thus far, and I guess what you expect to see this week from these banks? Is the consumer still doing well?
So far, yes. So the one other than delinquencies, which we have seen monthly updates of, the growth in cards seems to continue to be robust. Now, spending could be a little bit of an illusion in the second half of this year, given holiday spending, back to school spending, but I think so far consumer health is okay. I'm a little bit more nervous about 2025. I do think that the excess deposits, and you're seeing that in the data from the consumer, has been drained down in terms of the COVID-related liquidity. And so as I think about 2025, I think the market is a little bit too complacent that we're going to hit this perfect soft landing. And so I'm a little bit more nervous about the consumer strength sustaining beyond holiday season.
It's interesting. When we talk about consumers, kind of Main Street versus Wall Street, I'm curious about your view on what businesses are going to be doing better. Currently, the market is allowing Bank of America to trade at a 1.2 times book value. Goldman is richer. So is Morgan Stanley. So is JP Morgan. Is it those Wall Street businesses that are really going to be driving performance moving forward?
So I feel like that's a bit consensus, right? So everyone is thinking, okay, there's a lot of election uncertainty. Once we get over that hump, oh my goodness, capital markets activity is going to pop off. I've said that word before on the show, pop off in 2025. That's why those stocks and the boutiques also are trading at those higher multiples. But if we have a soft landing, I think the massive multiple expansion that you'll see will actually be in the regional banks. We'll also be reporting on Tuesday, because they're the ones that have taken the brunt of higher interest rates, dragging deposit costs higher, the concerns over commercial real estate. And keep in mind that 200 basis points off of Fed funds is much more meaningful to a commercial real estate loan that's at 5-6% than it is for a 25% APR credit card loan.
And when it comes to the regional banks, I'm glad you highlighted them. It seems like everyone agrees that there should be consolidation in that space. I mean, we heard from Jamie Dimon speaking with Lisa Abramowitz last week saying the same thing, that these banks should be allowed to merge. Do you think we're actually going to see that, though?
So I think that the Capital One Discover deal closing will be a good or not great sign, depending on what happens, for these buyers to go after it. But honestly, I think it's the election once again. Who's going to take risk as announcing a deal right now with, the election futures essentially 50-50. I do think you'll see consolidation in 25.
But is that the only part of the story? I'm curious, because that point you're making about commercial real estate, we might not see rate cuts to the degree that the market is currently expecting. Do you need that type of change in the interest rate environment to have these stocks really, as you say, pop off?
For sure, right? Because if we have fewer rate cuts, then the winners are clearly going to be the money centers, right? They're the ones that could perform the best in terms of a flat yield curve. They already have all these retail deposits, all these checking accounts, essentially earning zero. And so they ultimately had a better funding benefit anyway versus regional banks. So you're absolutely right. If we erase the 200 basis points in total that the curve is pricing in, including the 50 we just had, yet again, it's the money centers who win.
What are the single names you like in this market?
I really like PNC. So PNC is a regional bank where you don't need a 200 basis point rate cut for it to work. It's sort of the JP Morgan of regional banks, if you will. They have a lot of capital. They have a great management team. And they're ultimately going to be transformative over the next 5 years because I do think they're going to be the consolidator in the regional bank space. And by the way, they bought the old Compass franchise from BBVA during the pandemic. You know, they expanded very smartly. And so they have more fishing lines in the water if commercial growth does come back.
All right, Erika, got to leave it there. Great to see you again. That is Erika Najarian of UBS.
PNC out with earnings tomorrow morning at 6:30 a.m.
Many people say it's the JP Morgan of the regional banks.
Erika Najarian says so.
Yes, exactly. That's the joke. On Wednesday, tune in for our interview with Morgan Stanley CEO Ted Pick. That's live here on Open Interest at 10:30 a.m. New York time. Now, still ahead, who's the richest woman on Earth? A Walton heir takes the crown. Details in Social Climbers next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, we have Wynn Resorts falling along with other casino names after the election of a new Macau leader who warned against the dominant role that the gaming industry plays in the local economy. Really interesting sort of peg to take there. But you can see Wynn Resorts, not too much movement, currently down about 0.5%. Next up, we have the Danish pharma company H. Lundbeck agreeing to buy Longboard Pharmaceuticals in a $2.6 billion deal. Now, that deal will boost Lundbeck's drug pipeline to treat brain diseases. That's good for a 51% surge. And then finally, the heiress to Walmart is leapfrogging the L'Oreal heiress to become the world's richest woman. We're speaking, of course, about Alice Walton. She is the daughter of retail icon Sam Walton, now worth more than $95 billion for the very first time. You can check out, of course, the ranking of the world's richest people at Rich Go on your Bloomberg terminal. Of course, to follow all the latest company buzz, check out TREN Go on your Bloomberg terminal. But right now, let's take a look at this market. Of course, it is the first trading session of this week. The bond market closed. The stock market opened for whatever reason, but it's probably a good thing because the S&P 500 currently higher by about 0.7%. We were talking about NVIDIA's gain earlier. That has been the story of the NASDAQ 100 this morning, currently higher by about 0.9%. Of course, Jensen Huang out with bullish comments on Blackwell, as you would expect there, but still lifting the broader benchmarks. Meanwhile, volatility, we are still trading with a 20 handle on the VIX, Matt, but dropping a little bit. Of course, one to keep an eye on.
Yeah, and we haven't mentioned really Christopher Columbus at all today. The bond market is closed to honor Columbus Day. It's a federal holiday, which I find kind of weird because Columbus never landed or set foot in the United States, right? I think he went to the Bahamas first and then Hispaniola, which is like the DR and Haiti, but...
My favorite thing about sitting next to you on set every day is how much I learn in history. Another thing we haven't talked about today because of Indigenous Peoples Day is the bond market, which is not trading today. 410 on the 10-year, it's stable. The question is, do we get higher than that? It's that 4.5% level, which is that extraordinary height that starts to mess with the stock market. So let's see if we see.
Well, it's not quite 5%. I feel like all things considered, the stock market has been pretty resilient, of course, with all the bond volatility really that you've seen, and of course maybe a lackluster earnings season coming up. Now, coming up, we'll speak with the CEO of Gallagher, of course, a global insurance brokerage. This is Bloomberg. Well, recovery efforts are underway after Florida was hit with back-to-back hurricanes. Research from Bloomberg Intelligence suggests that insurance claims could be in the tens of billions of dollars. Joining us now to help make sense of it all is Pat Gallagher. He is chairman and CEO of global insurance brokerage Gallagher. And Pat, it's great to have you back with us. Let's talk about the dispersion here, because there's really expected to be quite a large gap between, of course, the economic losses, but then the insured losses. And I'm wondering what that means for Gallagher in particular.
Well, I mean, first of all, okay, before I say anything, we always have to recognize that these are numbers that we throw around in our industry. They relate to both the economic loss and what have you, but this is about people. And I'm glad to say all of our people in that area are safe, but there's an awful lot of folks that have had severe damage, some loss of life, and that's always the most important thing. Of course, when I talk about the loss, of course, we're looking at the math behind it, and our Gallagher Re numbers as of this week have improved a little bit. It looks as though this is going to be, between the two major hurricanes, about a $35 to $45 billion insured loss. Now, let's put that in perspective. I mean, most of us don't own homes that in and of themselves are worth millions of dollars. So there are thousands and thousands of people who have severe, severe damage. And what's been interesting about, in particular, Helena, is that the losses were not just wind and surge related or flood related in the Florida area, but the damage and what have you up through Asheville, North Carolina and the like is just unprecedented, coming primarily from rain losses. So these storms have been substantial in size, caused an awful lot of damage, and of course a lot of economic loss that's not insured on top of the $35 to $45 billion that's likely to be insured.
Pat, I think it is right to first say that, we feel for those people who not only have suffered, obviously loss of life, physical injury, but also a lot of people have suffered losses, financial losses that they will not be able to deal with. Which kinds of damage is not covered? I mean, for example, coastal homes, oftentimes the flooding damage floods can't be insured against, right? I'm not sure how it is in Asheville if your property was damaged or destroyed by rains or mudslides. I mean, what's not covered?
Well, here's the thing I think that's something that's new in terms of what individuals and businesses should be thinking about. Forever, we've lived off of flood maps. And the mortgage holders have said to those of us that are consumers, inside of this zone, you must buy flood insurance, whether it's from the National Flood Insurance Program, which is available across the board, or through private insurers, which can be arranged in some instances. Many, many people look at that as determining their need to buy insurance. And I'm saying, look, we've got to look at places like Asheville, places inside the United States, all the way as far as Nashville, Tennessee, and say, well, whether or not you have to, should you? So back to your point, Matt, there's a lot of damage here that is not insured. Now, most people on the coasts and up rivers and what have you can start their cover with the National Flood Insurance Program, which is a federal plan. And then there is usually coverage available excess of that. It can be very expensive. In many instances, it's not purchased. And I understand that. But the fact is, there's an awful lot of the damage, to your point, that's happened from these hurricanes that will not be insured.
Pat, the cost of insurance in this country has already been on the rise in many, many ways. You see it in inflation rates, but you look at these back-to-back hurricanes hitting places that may not have expected it. How might that start to reset insurance rates once again? Where might there be even more increases?
Well, you're exactly right. There have been an awful lot of increases over the last 4 to 5 years. First of all, let me just step back from that and say this is one of the things I'm so proud of when it comes to our industry. Our job as an industry is to spread loss. We basically take the masses, not the masses, but the many pay for the losses of a few. Now, it seems like there's not a lot of fews here. There's a lot of losses. But the fact is that the industry, I think, does a remarkable job of doing its job. Now, what's interesting to me here is our Gallagher Re organization provides reinsurance, as you know, to insurance companies. It's insurance for insurance companies. And while insurance rates over the last 5 to 6 years have gone up, we're not seeing the need in all likelihood to have substantial rate increases across the board based on these losses. It looks as though these losses will be contained as an earnings event for the primary insurance market and probably not a huge balance sheet event for the reinsurers, which does create an impact for the consumer pricing. So while there will, in the areas that got hit directly, clearly be an increase in cost, the industry once again will, I liken it to a boxer. These are body blows, but the person is still in the ring, and our industry is still there to help people spread risk. And I'm very proud of that.
And I'm glad you brought up reinsurance, of course. You're big there. You've made acquisitions in that space. I also want to talk about the claims adjusting business because I understand that's pretty sizable as well. And you think about the impact, of course, what we're seeing in Florida in the result of Milton and the result of Helene. I mean, what could it mean when it comes to insurance claims adjusting?
That's a very good point. It stresses everyone out. These claims, but I'll liken it to the work I think that the utilities do, which is great work getting people's power back on. When these losses occur, the industry does flood the area with adjusters that are professional adjusters that understand how to adjust the loss against the policy that's in place. And there's thousands of additional hands-on. But I would say this to your viewers. Stay involved in the process. So many times people phone in and say, here's my claim, somebody do something about it. And I get that, but it is important if you want your property to be one that gets looked at early on, be positive, stay involved, understand who your carrier is, and be part of the process. It will help it move along better. But not unlike the power companies, our adjusters, and I mean the industry's adjusters, will be on site. Our companies will take the claims, and as they necessarily need to flow through the industry to reinsurance, the reinsurers will pay those claims as well. And once again, the industry will prove that while I am very positive on what FEMA provides and all the work that those people do, in the end, it's the insurance industry that puts these places back together. And the whole system does work. And it's a remarkable system, actually.
Pat, I want to ask about Gallagher, the business. I always say it's the biggest insurance broker you never heard of, although if I continue to say that, obviously everyone will have heard of it.
Thanks, Matt. Keep putting me on, would you?
You've grown tremendously under your tenure, and more CEOs watch this network than any other. So I'm sure they'd be interested to know, how do you deal with this kind of growth? I think you've sextupled over the last decade in terms of market cap, and still maintain the culture of Gallagher?
Well, first, Matt, culture, I believe, is the single greatest factor in success or failure of any human enterprise, and I will include your family in that. So it's that important, and we talk about it all the time. People ask me quite often, how can you do 100+ acquisitions in a year or every 18 months and change their cultures? Well, we don't. 99% of our due diligence, the brokerage P&L and balance sheet is easy to figure out. Due diligence there is easy. The real due diligence is on the culture. And we find people that we think are great folks who love this industry because of what it means to society, themselves, their family, and we try to buy them. And that's been a large part of our growth, as you mentioned, over the years. I'm very proud of our growth, and I'm very proud of our team. What you'll realize if you look back over the period of time that we've done the growth is we don't have many failures in this regard. I think our failure rate on acquisitions is way less than 5%. And again, it comes back to that culture. If people don't fit, if it's not about the customer first, if it's not about their people second, and then about earnings, they don't get it. And that's what we find.
Pat, we thank you so much for your time. That is Pat Gallagher, Gallagher Chairman and CEO. We're now going to get a check on these markets with our own Bloomberg's Abigail Doolittle.
Well, we are seeing nice gains for the S&P 500. Sonali up about 0.7% today. Over the last 5 days, you can see a good rally, up the better part of 3%. Robust rally, broad based. However, on the day, we do have mixed markets to some degree when we take a look at other indexes. Now, the NASDAQ 100 and stocks, those chip stocks, really outperforming. NVIDIA near an all-time high, some relief around the idea that production might be okay. But take a look at the Golden Dragon in China index, down 0.7%. Some disappointment that the promises for stimulus out of Beijing didn't include a specific dollar number. And then the transports down, but well off the lows, down right now about 0.25%. As for earnings tomorrow, we do have Goldman Sachs reporting. Everybody will be paying attention to their banking pipelines and feedback from clients. United Health up 0.5%. Medicare Advantage, what they talk about relative to those clients and who they can gain during enrollment will be important. Then in Netflix, now down about 0.5%. It had been higher earlier. We'll, of course, be looking for an update on Netflix around paid sharing and, of course, the ad business for them. Right now, again, down just a little bit, but on the year, Netflix up quite a bit, Matt. So a little bit of a dent in that game, but overall, again, Netflix higher on the year.
All right, Abigail, thanks very much. Abigail Doolittle there talking to us about Netflix, some of the other stocks moving in the first hour of the trade. Coming up, a story about the changing perception of nuclear power. Holtec International President Kelly Trice discusses the low risk surrounding the energy source. This is Bloomberg.
It's time now for our daily Wall Street Week conversation. Chernobyl, Fukushima, and 3 Mile Island may come to mind when talking about nuclear power, but is public perception shifting? David Weston speaks with Holtec International President Kelly Trice about the safety and the reliability of nuclear energy.
Nuclear power has evolved quite a bit. The original reactors were constructed in the 50s and 60s. I call the father of nuclear power, Admiral Hyman Rickover from the Navy. They were designed for use in submarines and eventually aircraft carriers and a handful of ships so that they could go anywhere in the world for long periods of time, stay submerged for long periods of time, and improve the United States capability. The other thing that happened, though, is in the process, we discovered that nuclear power could be used for civilian purposes. And so we started constructing nuclear reactors, and the big reactors in the United States were built mainly in the late 60s, all through the 70s and the early 80s. And what's happened along the way is we've developed better techniques, we've discovered better ways to handle nuclear fuel. We've discovered that the waste stream is actually much smaller than people think. In fact, when you look at the entire waste stream of the United States, it would fit on 2 football fields, right? And that's 50 plus years of operation. So I think our waste ability is better, our fuel handling ability is better. Of course, technology has improved with both metal and pipes and valves and electronic systems. And training and human factors are much better as well. So today we think it's one of the safest and most reliable forms of energy there is.
Has the risk gone down? Because obviously from Chernobyl and from 3 Mile Island, there were really a lot of doubts about nuclear power.
Yeah, I think the risk is substantially lower, especially when you consider it compared to chemical plants or other forms of generations of power. And I tell people a lot of times when you look at Fukushima, which was, probably one of the more recent difficult nuclear plant issues where they had the tsunami, and that tsunami caused, 5-6 reactors to lose power and 4 of the reactors had damage. In the reactor damage and the nuclear accident, not a single person died. In the tsunami, 10,000 people died. Yet what we talk about is the reactor accidents, right, which were profound, right? And then in the course of that, they have to be fixed and the cleanup has to occur, and they are substantial events. But if you look at 3 Mile Island, same thing, no fatalities. If you look at, probably the worst one of all would be the one in Russia, which was Chernobyl, or in the Ukraine at this point. Even that, minimal fatalities and deaths compared to other natural phenomena that occur in the world. Now, our goal, though, is 0 accidents, 0 fatalities, 0 injuries, and 100% performance. And that's what we want to attain.
Has the public perception of nuclear power changed in the United States or in Europe?
Yes, I think it's changed dramatically. Kind of amazing, actually. And I knew that it had changed. A few weeks ago, I got a call from some high school kids, and they wanted to interview me for a school project because they were considering nuclear engineering as a field of the future that they wanted to be in. That told me a lot about how the population had changed.
And that was Holtec International President Kelly Trice. You can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
There's a housing affordability crisis in the United States, decades in the making. I spoke with Zonda's chief economist, Ali Wolf, to learn more about the crisis and how both presidential candidates are looking to fix the issue. Here's what she said about Kamala Harris's plan.
So her plan is to add an additional $3 million beyond what builders were already planning to build. And the first thing I would say is it's well intended. It's a nice idea. But for builders, if they could build more homes, generally a lot of them would want to. And if they could, they would do it. We know that there are so many limitations to being able to reach that goal. Well, I know that the candidate Harris is looking at, okay, maybe we can remove some regulation.
Certainly a big issue in this election cycle and no easy fix. You could read the full interview online and in the latest issue of Bloomberg Markets Magazine. Let's stick with politics here. Bloomberg senior editor Mike Shepard joins us now from Washington with the latest on the race to the White House. And the big question is still the economy, is it not? You look at where we stand right now, and how are both candidates looking to make an edge?
Well, it's interesting that you brought us into this segment talking about housing, because each candidate has tried to make housing a part of their larger economic agenda. For Trump, he has talked about reducing regulations, using federal land to make more homes available for construction, and even, and this is a classic example from the Trump playbook, turning it into a question about immigration. He has called for barring undocumented migrants from obtaining mortgages. On the Harris side, she is talking about $25,000 grants for first-time home buyers, and then billions of dollars in subsidies for states and local governments to try to speed some of that. And what this is, what we're seeing here is that each candidate is trying to aim at a part of the voting population that feels left out of the economy right now. And housing is one area in particular for young home buyers, for younger voters that they're trying to reach, and also for people of color as well in this country.
It is, a surprising amount of coverage, Mike, over the weekend in the New York Times about how Harris is not able to get the black and Hispanic vote, how they're still going towards Trump. What is she doing about that? How can she get, especially, black males to vote for her?
Well, this is a big part of the Harris campaign's swing through three key industrial states this week: Pennsylvania, Wisconsin, and Michigan. She'll be visiting several times to each location over the next several days to try to make this outreach to black voters. Over the weekend, we saw a New York Times poll indicating that as many as 15% of likely black voters would be casting their ballots in favor of Donald Trump. And that's an increase of as many as 6 percentage points from the past two elections. And this is concerning for the Democratic Party as they look at a key constituency and try to make sure that they can get every vote that they can turn out come November 5th. But if they can't count on black voters to support Harris with the vigor that they need, those swing states, which will be crucial to ensuring a victory against Trump, could be in jeopardy. So she will be making these appeals, meeting with black voters individually in Erie today. Tomorrow she will be appearing on Charlemagne the God's radio show in Detroit. And then later in the week, there will be more events. Earlier today, she also unveiled a policy package aimed at bringing along black voters by promising easier startups for black entrepreneurs.
Right, and you've also seen former President Barack Obama also come to her side when it comes to that issue and that voter cohort specifically. Mike, we only have about a minute left with you, but there's 21 days until the presidential election. We talk about this razor-thin polling. Who's left? Who's still undecided at this point?
I was talking to political analyst last week who said that there is a vanishingly small number of people who really haven't made up their mind. And it's much more a question about voter enthusiasm and motivation at this point. If people in this country haven't made up their minds between Trump and Harris, it is very, very small group right now that the two candidates are fighting for. Instead, what they are trying to do is aim at their base with their messages to try to ensure that they get maximum turnout on Election Day.
All right. Bloomberg's Michael Shepard joining us from Washington with all the latest political news. Really appreciate your time and your reporting. And tomorrow, Donald Trump will sit down with Bloomberg editor-in-chief John Micklethwait for an exclusive interview at 12 p.m. Eastern. Clearly very excited for that one. Definitely tune in for that. But before we let you go here, let's take a look at these markets. Of course, it is the first trading day of the week, and we have a rally on our hands. The S&P 500 currently up about 0.7%. Big tech still your leader, but by a more narrow margin here. You could round that up to about 0.8%. And I was talking about that 20 handle on the VIX. No longer. The VIX currently trading just a hair below 20, but as we all know, there's been a lot of volatility in this market, and you've certainly seen that reflected in the VIX.
It's interesting because the VIX, even at 19, is above the average you've been looking at 6 months or so. 15, that's the average you have. But, you know, I also think what's interesting is the trade we have heading into this earnings season. Most major sectors in the green today, guys, just hitting a new record on that index.
Right. We have a ton of new 52-week highs.
Yeah.
But we're trading on a much lighter volume, right? Currently 15 to 20% lighter because it is Columbus Day.
It is.
And the bond markets are closed. Fewer people are in the office.
All right. Coming up tomorrow on Open Interest, it's a big lineup. Gerard Cassidy, RBC, Cameron Dawson over at New Edge, and Johnson & Johnson CFO Joe Wolk. This is Bloomberg.